What's up, my friend? So I had to talk about this right now. The Fed just cut rates, and now every headline that I see is screaming cheaper borrowing, like pivot, hawkish cut, and everything else. And you're probably thinking over there, is this finally my moment to buy a house? Or is this just another round of noise that's going to leave me more confused? And you're hearing that the Fed cut, but you're also probably hearing that they're being cautious about 2026. And meanwhile, you're staring at your rent, or maybe you're scrolling listings, wondering if you should jump in, wait it out, or just give up on this whole thing. If that sounds like you, I want you to stay with me because we're going to unpack what this latest Fed move really means for you as a home buyer, how it actually shows up in your mortgage options, and 3 specific game plans that you can use so that you're not just reacting to the news cycle, so that you're making a smart move for your situation. Now, here's the deal. The first thing that you need to understand is that a Fed rate cut and a mortgage rate are cousins, not twins. They're related, but they're not the same. The Fed just made a move that affects very short-term interest rates, like what banks charge each other and what you might see on credit cards or certain lines of credit. Mortgage rates, however, especially for longer-term loans, are driven more by what investors think will happen with inflation and the economy over the next several years than by that one announcement. So when you see Fed cut, it doesn't mean you wake up tomorrow and every lender is suddenly offering dramatically cheaper mortgages. Sometimes the market has already priced in that move weeks or months ago. Sometimes mortgage rates drift down a bit, sometimes they barely move, and sometimes they even bump up if investors think that inflation could stick around. Let me give you a concrete example. Imagine you've been watching homes in your area around a certain price and you've talked to a lender who gave you a ballpark idea of your payment at recent mortgage levels. The Fed cuts in December, you're pumped, you check again a week later, and your lender says your payment estimate's a little better, but not wildly different. And that's normal. The Fed move is more like nudging the steering wheel than slamming on the brakes. So knowing that, how do you actually make a decision? Let's walk through 3 real-world strategies. Strategy number 1 is what I call buy the house, not the headline. This is for you if you've already run the numbers, you know roughly what kind of payment you're comfortable with, and you've been waiting for some kind of green light from the news to say go. Instead of trying to time the absolute lowest possible rate, you look at your life first. Do you plan on staying put over the next few years? Or are you sick of rent increases every 12 months? Do you have a stable income and a reasonable savings cushion? This Fed cut can be a nice bonus signal, but not the main reason for you to move forward. For example, let's say you're paying rent that keeps creeping up every year. You find a home that checks your boxes, your estimated mortgage payment is affordable when you factor in your actual life things like daycare, your car payment, your streaming options, the nights you order DoorDash, and even if rates wiggle a little bit, that payment is still within your comfort zone. In that scenario, waiting 6 to 12 months, hoping for a slightly lower rate, can mean missing out if home prices move higher or competition returns. The move here is to lock in something that works for you now with the understanding that if the rate environment becomes more favorable later, you can explore refinancing. There's a saying that you probably heard before. You date the rate, you marry the house. Now, it's a little corny, but there is some truth to that as long as you're not stretching yourself thin today. Strategy number 2. This is for the cautious planner. You wait with a plan, not wishful thinking. This is for you if your numbers are tight right now. Maybe your income is in transition, or your debts are a little heavier than you'd like, or your savings is still a little bit light. A Fed cut doesn't magically fix that overnight. In this case, you're not wrong to wait, but you should be very intentional about how you use that waiting period. So instead of just scrolling Zillow and hoping, you want to build a real roadmap. Ask yourself these 3 questions. If you buy right now, what specific part of the cost is the problem? Is it the monthly payment, the upfront cash needed to close, or is it just the uncertainty of your job or income? The next question is, in the next 6 to 12 months, what's realistically going to change? Are you paying off a car loan? Are you expecting a raise? Are you cleaning up some credit card issues? And the third question, how will you know it's time to move from waiting to acting? For example, you might decide once my credit score improves into a stronger range and I've paid down this credit card, I'll revisit the numbers, and if the payment lands inside the specific comfort zone, I'm ready. That's very different from I'll just wait until rates drop, because you and I both know We can't control that. A Fed cut today may or may not lead to a smooth downward glide path for mortgages. Your personal finances, though, you can actually control those. Strategy number 3 is for current homeowners. Use the Fed move as a prompt to stress test your current loan. If you already own a home, you might be wondering if this is your refinancing moment or a chance to restructure some debt. The cut, plus whatever happens in 2026, could open a window where refinancing might make sense, but only if the whole picture checks out. That means looking at your current mortgage balance, your remaining term, your other monthly obligations, and what a new payment and term could look like. For example, maybe you've got some high interest debts hanging around and your mortgage is at the point where, if the numbers align, rolling everything into one new loan could simplify your life and give you a more manageable overall payment. But you also have to look at the trade-offs. Extending your term too far out to lower the payment can mean paying more interest over the long haul, and refinancing too often, just because headlines change, can eat up your savings and costs and fees. So the smart move is to run the full before and after scenario, not just chase a new rate because of the Fed. Now, I know this is a lot to juggle. Fed policy, mortgage markets, your income, your debts, your goals, and trying to stitch it all together from random articles and social media posts is honestly a headache. That's exactly why I put together a free guide that'll walk you through how to think about a Fed move as a home buyer, step by step. It breaks down what changes, what usually doesn't, and gives you a simple way to compare buy now, wait, and refinance options using your own numbers. It's linked for you right down in the description. So here's how you move forward from here. If you're even a little bit serious about buying or restructuring your mortgage in this new Fed environment, grab the guide. Look at the simple checklist, and then when you're ready, book a strategy call with our team using the link below. We'll take your actual situation, your income, your debts, your target price point, and we'll map out which of these 3 strategies fits you best without the hype. Don't let confusing headlines or fear of bad timing keep you stuck on the sidelines. Click the link in the description to grab the guide or book a strategy call with our team. We're here to help you make a calm, informed decision that fits your life, not just a news cycle. And if you found this video helpful, feel free to subscribe. I'll see you on the next one.